comes down to computers communicating.
The information superhighway can be a confusing mix of on-ramps and off-ramps.
Bitcoin is worthless artificial gold.
Is it still rat poison?
Probably rat poison squared.
We need to get into the world of, okay, this is actually foundational technology.
What the Internet of Money does is it creates a single network which can do a microtransaction to a gigatransaction.
The Internet is going to be one of the major forces for reducing the role of government. The one thing that's missing, but that will soon be developed, is a reliable e-cash.
Hey guys, welcome back to another episode of Final Settlement. This was an exciting and action-packed episode. No shortage of M&A deals and new products and releases in the ecosystem. Quick word from Onramp, an Onramp business specifically. I'm not sure we've had a chance to share it here. We launched this a few weeks ago. Incredibly excited about the product. We announced a case study with a large firm, but also really foundational infrastructure needed for businesses across the landscape that are adopting Bitcoin as a treasury reserve asset. Not only is multi-institution a superior way to custody the underlying than trusting a single custodian, but then naturally what's existed or what hasn't existed in the digital asset Bitcoin world is governance, access-based controls, and everything that generally exists in the traditional financial system has not been ported over when it comes to just treasury management of the underlying Bitcoin. And so with Onramp Business, institutions, enterprises get access to multiple users. They get access to creating quorum of quorums so they can decide on who has access to check off or approve a transaction before the withdrawal takes place. And then you get complete audit controls as well as multiple wallets, different quorums, everything that a large-scale institution would need. Really excited about this announcement. We're starting to onboard publicly traded companies as well as other large institutions. If you want to learn more, I'd encourage you to book a consultation or reach out. All right, on to the episode. I hope you guys enjoy.
All right, gentlemen, welcome back to another episode of Final Settlement. Today is December 1st, 10:20 a.m. Eastern Standard Time. Gentlemen, how was your holiday weekend? Good Thanksgiving, I hope. I take it. Spend some time with family.
Great Thanksgiving. Seems like there's more people than I would have expected that really own Bitcoin, at least in my broader family, but there's a real lack of understanding about it. So, you know, the sentiment is solid, but they're coming out there saying, should I sell all my Bitcoin for Ethereum and everything else like that? So clearly not listening to the pod or doing quite as much research as we do day to day. It's just, it's good to always have the sentiment check that there's a lot of people out there that are interested, but not quite as deep as we are.
Yeah, it's been a quiet year. I think this year being day to day, doing the pods, being in the weeds in this industry, you think a lot's happening, and there is, but outside from a market perspective, it's like the Bitcoin thing's just kind of hanging out there. Oh, you're still into that.
The Trump Bitcoin thing.
Trump Bitcoin thing, but good Thanksgiving. Interesting that it's like, I don't know what it means to be this late. It came up yesterday, but the fact that we're in December already is pretty wild. The end of the year is upon us. We only have like about three business weeks left before things start to wind down. I feel like it's going to be a volatile end of the year. I don't know which direction, but it isn't. I don't think we're going to be sitting here in January still at $85,000.
Yeah, I mean, it's been a very, from a sort of historical volatility perspective, it's been a very muted year for Bitcoin. We've kind of been in this large range from, call it 75 to 125. We just oscillated back and forth. But Liam, that's good to hear, I guess, in some ways that some family members are adopting Bitcoin, but maybe they're listening to the Tom Lees of the world on MSNBC instead of Final Settlement or The Last Trade. So we just switch up their signal.
A lot of spike coiners too, who just hate Bitcoin, but they don't want to be wrong about it too. So they just want to have at least a little bit.
Many Bitcoiners begin as spike coiners, and then you learn more, you find more signal, and you graduate from being a spike coiner. But we're going to start today with some news from last week around Tether and some broader discussion that, course, this is not new. There's been questions or concerns around Tether's, quote unquote, stability or their reserves in general as backing for many years. And so this is sort of the latest round of that. So the S&P downgraded Tether to a rating of weak, citing their Bitcoin holdings as a concern. And so just as some context for what this is not a typical sort of S&P credit rating. A couple years back, they created what they call the Stablecoin Stability Assessment. And so this is a stablecoin specific sort of rating, and it goes from 1 to 5, with 5 being the weakest. And so they gave Tether a 5, effectively, citing effectively this buffer in their reserves of assets, namely gold and Bitcoin, that right now is a positive buffer. But effectively, the concern would be, if Bitcoin and gold were to decline materially, then that positive buffer would potentially become a negative buffer, and they wouldn't have full backing with U.S. Treasuries. And so there was some discussion from Arthur Hayes on this, pulling up their Tether's most recent assertion. And maybe, Liam, I'll hand it to you to give a little bit more color on what Arthur is arguing, and then we can go to what Paolo from Tether responded to this as well.
Yeah. Essentially, they audited one of Tether's subsidiaries / business units, and right now, Tether is significantly over collateralized. So if you pull up the chart, it looks like outstanding, I think there's about $180 billion in USDT. And then right now there is, about 60+% of that is in US Treasury bills. And then a lot of other similar units, overnight repo, reverse repo, money market funds, cash, and bank accounts, etc. And then there's also a little bit that's a little bit more risky than that. Secured loans, I would imagine a lot of that is Bitcoin collateralized lending, as well as corporate bonds. And then there's about $3 billion in other investments. That's probably some of their VC related things. And then they have about combined 24-ish billion in gold and Bitcoin, with the most of that being in gold. So as of right now, what S&P and some others are arguing is that if there was a 30% drop in the price of gold and Bitcoin, and at the same time, there was going to be a run on all of the stablecoins, essentially trying to redeem at par, there would be a shortfall based on this audit. However, Paolo kind of argued that at the same time, that's not how they should be looking at this, because the Tether group just passes back dividends to the rest of their other subsidiaries, and outside of that, they have fully collateralized their outstanding stablecoins in the form of short-term treasury bills, and they have other assets that can meet any redemptions. So a lot to say that this is going to probably spook some people who are, definitely less sophisticated, who thought that everything was one-to-one and are looking for auditors to confirm that, especially if you have fiduciary duty to shareholders and want to make sure that, any stable coins that you hold, your counterparty is definitely going to be 100% solvent. So I would imagine that this is their first audit. So maybe they just have things in different subsidiaries that they didn't necessarily know need to be in certain places. But probably a little bit of concern for institutional investors who want to make sure that they have everything squared away, as well as will be big, because I know Tether was looking to raise at a $500 billion valuation. So this may shake away a few people, but I'm sure that at some point in the future, they're going to have this 100% squared away. And yeah, that's kind of where this audit landed.
This is a fun one to talk about because I didn't do a deep dive. I think there's a thread we should pull on after this, is just the crazy FUD in general and what's happening. Where there's smoke, there's fire. I think there's a lot of discussion to be had around the JPM Sailor and whatever's happening there. But I think when you just see this domino of continued kind of just smoke around the industry, I think there's something happening. But independent of that, on this, I have a few interesting takes. I'm curious your guys' thoughts. I'm not fully formed, but one is I don't think that they mistake or was their first time auditing. Like they've been asked to audit for basically a decade now. They've always had this FUD around backing that they're very sophisticated. We can't give them the credit on everything they do and then be like, well, you didn't know how to audit. I think this is as best as they could put their book to look. Now, where I don't think anybody's right or wrong here. They're just stating the facts. Is there's no safe play. We've talked about this before. I forget if it was last trade or here, but there's no safety net. Like if you're all in BTC, you have to stomach the volatility. And if you're all in dollars, you have to stomach the volatility of losing your purchasing power. And if you're all in treasury bonds, you have to stomach the volatility of also losing your purchasing power. And to Arthur's point with Tether, is that they are concerned because their business model relies solely on interest rates and generating income from the issued Tether and the reserves. And if they expect that the market, whether it's because purchasing power or also interest rates are going to be lowering, well, they theoretically do not want to wipe that out. They want those reserves and that capital to be secured in hard assets like gold, Bitcoin. And they're basically playing a game of, and we talked about this last week. I was recording a podcast with founder and CEO of Ario, Gustavo, and Lynn, and she was asking a common question about like startups and Bitcoin and how much Bitcoin do you hold on the balance sheet? And it's like, well, it's more of an art than a science because you have to be willing to step into equity and other positions, maybe personal balance sheet. If the price retraces, if you don't have that optionality, well, then you probably want more in dollars. And so point being is, I think Tether's doing what they have to do. I think that Arthur's also doing what he has to do because he has his own, I believe, stablecoin he's backed. And I do think it's really fascinating to look at, well, they're claiming to have equity that they can tap and other things to make the whole if there was a gap. But like when the price retraces, the market kind of goes no bid for like whether it's your equity to tap it out and your equity is not worth what it once was. So there's that. The last thing on all of that is I think the Tether in general is in an interesting position because they're becoming almost systemic in the sense of they are relied on so much in the crypto and digital asset space, and they've historically had different ways to make gaps whole. I think most people forget or didn't even know back in, I want to say it was 2019, when I think $750 million was seized out of, I think it was the Deltec Bank, where they secured assets because of just all the kind of shadiness that Tether and their banking partners were involved with. They had to make that whole. And so they issued the Leo stablecoin. And there was rumors that they had unpegged. I think it's pretty widely known within the industry that they've unpegged from their dollar stablecoin multiple times over. But the reality is because it's the dominant trading pair in crypto, most people gloss over it, believing that they will be able to make it whole. And so I think that's where we're kind of heading to, where if there's ever a world where this happens, somebody's going to step in. Yeah, I'll pause there. I know there's a lot. There's some other thoughts, but I'm curious, Brian, what you got?
Yeah, I kind of see two big disconnects in terms of like how this is being perceived and what's the reality on the ground. The first that you sort of alluded to is the systemic nature of what Tether has become, and particularly with, with the context of this administration and their push around stablecoins and, the Bo Hines of the world sort of, crossing the chasm between the actual administration and then now working for Tether. And then you have the Cantor relationship, which has existed for years. And then you have them launching, USAT. Like they wouldn't be doing these things and having these, tightening the fidelity of these existing relationships if they weren't going to ultimately get to a compliant place. And that was the big story from the summer, was that with the passage of the Genius Act, like Tether was not compliant, but they had this 3-year window to get compliant. And so I think one part of me just says like we're in the early stages of that. And the other sort of big disconnect, and it relates back to a few weeks ago when S&P issued an actual credit rating for MSTR. And, the treasury company people were excited because they were just at least recognized by the S&P, but it was a junk bond rating. And the rationale around that was effectively they were looking at Bitcoin-based reserves as a demerit, not as a positive, but actually as, a negative. And so it's a very similar stance here in that, what Paolo and Tether perceive as an advantage in their reserves in holding gold and Bitcoin is perceived by S&P as a negative. And so that's just where we are in terms of people's perception of this. And so just the last thing I'll say is, like, I think Tether and Paolo are building a reserve of the future, not a reserve of today or yesterday, the past 40 years, where they don't actually want to be 100% in U.S. Treasuries in terms of, their reserves. Go ahead.
Well, but that was where I was going to. There's no safe place, because now understanding what we're talking about here is the S&P ratings, not paying attention to MSCR, but like to this, they are correct, because also independent of what Genius Act requires or doesn't. And I think that's the right point of, like, over time, whether it's the entity or the full entity, US and international, gets fully reserved, that their job is to back it 1-to-1, because somebody does not look at the dollar as speculative. They look at it as the reserve currency, and they look at treasuries as the risk-free rate. And so if you're going to back it with something independent of gold, because you can make a case against gold, but something that is still only 15 years old, is highly volatile, and something like quantum, nation state dropping, FUD, whatever it is, and the price cuts in half by 50%, and they're insolvent, well, then that matters to the counterparties that they're purchasing. And I think that's really now where the S&P, whatever rating, obviously, like, I think those agencies all don't make sense, but and they don't have much credibility. But if that's the take they're coming at it from, it makes sense. If that's also where Arthur's coming at it from, that also makes sense. And then if the markets, because it is a dance, like, it's not risk-free. To your point, they're building a treasury reserve of the future, but this being too early is the same as being wrong. I'm not saying this is going to happen, but it's just the reality. You get wiped out on BTC, and now you have a real problem with Tether. And then we saw this with Circle when there's a run, and that can get real hairy real fast. So I think it's worthy of the discussion. Now, are we going to retrace 30%? Is a different story, especially with gold.
100%. And they have the opportunity to be the only fully reserved, essentially, they're not a bank, but they can be equivalent to a bank or a money warehouse, where you can just essentially make sure, where you can't with other banks. And that's, we can go into why Custodia, wasn't approved for a federally chartered bank license if we want, but there essentially is no bank that's not fractionally reserved. And so if you had an ability for a stablecoin to come out and say, okay, here are all of our reserves, and the stablecoins, the short-term treasuries right next to it that have the same amount, like, that would be a massive draw, especially based on all of the growth that they already have. And that would probably even accelerate their ability to buy more gold and Bitcoin at a later date, just because they would get more people into their stablecoin. So there's a lot there, but I would argue that that's, like, really what people want and can be a big differentiator, and rather than a fractionally reserved bank today.
And one thing to call out is this is an interesting, like, dynamic, because I don't think anybody's right or wrong. It just is the current state of the market. I think this is where you start to see diversification come in. We talked about it last week with them getting into the lending. So that's where I was going to go with this, is like, what is looked at as a bug today will be a feature in the future, because I think majority of, we talk about free banking, and majority of quasi banks, and stablecoin issuers, and even eCash mints, and however that plays out, their assets that they're securing, that they're holding, their equity value will help and give the credibility and trust into who's using them. I think we're just still so early in Bitcoin's monetization, and we're still sitting here at like 85K, and there's all this, like, global macro stuff going on, that it turns into a bug, not a feature. But in the future, as Bitcoin is hundreds of thousands of dollars, and also as Tether's diversified their revenue streams, because I think that's a big part of this, right? Is like their revenue is literally coming from holding these treasuries, and then they're putting that in these other assets with the hypothesis or thesis that it's going to grow. But if they're in Bitcoin-backed lending and they're generating some kind of nominal yield above the Fed funds rate and these other different exposures, and that's, I think, the longer-term play. It starts to make more sense where they can hedge against some of the, like, stuff that we're talking.
Yeah, all good points. I mean, Liam, I'm curious what you think just on the notion that, because I think what Paolo is saying here is, like, Yeah, even if there was, because the numbers that Arthur is hypothesizing is like a 30% decline from here in gold and Bitcoin, which would basically be gold at a little under 3K an ounce and Bitcoin around 60K, which like, yeah, probably not likely, but not impossible. Certainly not impossible on the Bitcoin side. And is it reasonable or rational to assess the stability of one's reserves by looping in basically the equity of the business? Like, is it like, what do you make of that in terms of his rationale here?
It makes complete sense because this is it makes complete sense that's a variable. It doesn't make complete sense that that's your last thing to hang on, because this is effectively like BlockFi. I mean, this is where we talk about rehypothecation and counterparty risk, because back in 21, when we would compete against BlockFi for loans and BlockFi's interest rates were nominally cheaper, but risk adjusted much greater, you said that you understood it, but you could never fathom BlockFi just going to zero, because you think about like Peter Thiel and whoever else was backing it and the equity value as a multi-hundred million, if not billion-dollar firm. But the reality is math is math. And when you get off sides, it gets ugly really quick with not only the liabilities you have, but then also as investors pull back because there's no actual way to make people whole. And so it's funny that like just talking through, it's like the one thing we haven't even discussed is like what would happen if Tether and their counterparties and however they secured the Bitcoin somehow were hacked or lost a component of it, or what happens if the gold counterparty. So I was thinking about this over the weekend or whenever. I was like, where does Tether secure the gold? Because you always have counterparty risk with gold. Like you're not secure unless they have their own bunkers. I'm pretty sure they don't. But point being is, like, what happens when this will happen in the future as gold monetizes to $8, $12, $20,000, $40,000 a troy ounce. The ROI on violence becomes greater in these different regions. I think we saw this. We talked about it with Michael Petch and on one of the pods where it was like somewhere in Central Africa where they like jettisoned a helicopter and dropped down and stole, like, I don't even remember the number of ounces. Anyway, like it brings up other things that it makes sense if you're going to rate it if something happens to those underlying assets that are supposed to be securing these stable coins.
Agreed. If there it is a decline in the gold and Bitcoin price and everybody starts to try to redeem their stable coins or go to an alternative because there are more alternatives growing at the moment, the equity declines significantly over time, which is when they need it the most. But at the same time, I think it's also valuable to kind of take a step back and say, people have been flooding Tether for like 10 plus years, and there's never been a catalyst in order to make money off of that, right? And so I think that the prudent thing to do is kind of just watch it. And, if you're not invested in Tether, which many people aren't, like there's nothing to kind of do or actionable step from the Bitcoin side of the market other than kind of follow what they're doing.
Yeah. And maybe the last thing is, I think Brian's started off on this, is an interesting paradox because they're effectively getting damaged or like slapped for what the banking sector is at fault of. It's like there's nobody to bail out Tether. They, quote unquote, there will be. That's where I think that their stage is that, like, if they did somehow have a mistake, like somebody would step in from a like sovereign level. But if something like this happens to the banks, like SVB, the Fed steps in, you have all these things that happen. They close down over the weekend and then everybody's good on Monday. And I think that's what Tether knows, that they haven't historically had that. So they backed their business with hard assets, and now they're getting vilified for that. It's just a hard place to be in as we transition to this new monetization phase, which maybe is the last transition to JPM if you guys want to go there, because I think this is fundamentally where we talked about smoke on this area of the pod of, if you start to build fintechs, neobanks, whatever you want to call, that are actually backed with real assets, like these people are smart. They can kind of like understand that this is where a market is heading. At the end of the day, it goes back to the thought about, like, the common fallacy is what gives the dollar value. And people will say, well, it's the United States government and, stealth bombers, whatever. It's like, it's actually not true, because if the military doesn't recognize your money as valuable and they can't feed their family, they won't accept it. And it's very similar to this circumstance, was on a long enough time horizon. If your financial institution is insolvent and is handing out, funny money then maybe you go to the place that actually holds real money and it has the credibility of a longstanding firm with backing of gold and Bitcoin. And I think that's part of what's happening here with JPM and some of these other legacy institutions, seeing that there's a real fight happening.
Yeah, I was going to go towards this one, and then there was another announcement from Klarna launching Klarna USD. So, Liam, you sort of alluded to this, like the whole Tether thing is very much in the context of this broader competition around stablecoins generally. And so I think Klarna is going to build this on the Tempo blockchain. And so you're starting to see a lot of these what look and feel more like, enterprise style stablecoins. And then you also have the JPM news. So I don't know which direction you guys wanted to take it, but either of those cases.
I think the JPM one before this one, because it's a little different in the sense of in the Genius Act, it's part of the mandate. So you can have like a fintech neobank, somebody building in or around, because I think there's even narrow banking positions that are starting to come out where you can get access to the Fed window simply for holding treasuries if you want to build like a fintech for holding stable coins. Well, point being is they're treating deposit tokens as something fundamentally different, which are basically deposits that the bank has on behalf of its clients, which JPM trumps. I think in this article, they point out like so-called Tether has 200 billion or whatever. JPM has like 6.6 trillion in deposits, and they can effectively lend those out, quote unquote, unsecured, because that's just what fractional banking is. And so they're not hamstrung to the existing regulations from the existing stablecoin issuers. And then they can also participate in passing through yield generation. So it's a fascinating dynamic that's going to come about on how does that look. And I think this is stuff we've been talking about. And just a caveat, I'd be curious your guys' thoughts on the second part is we got a comment the other day on about talking about crypto. And I do think it's fair. Like we don't want to go too far down the crypto landscape, but I think Brian and I have always shared the sentiment that crypto is like sits as a test net for like what's ultimately going to happen on Bitcoin, because you just have this like design surface that is free from the constraints of legacy banking. And point being is that when you look at like stable coins, net settlement, money flow, you got to look here because eventually they're going to see Bitcoin and where it looks. And so you want to understand what's happening and how you're going to graft and layer on Bitcoin, because the Bitcoin camp's not doing it. Like they're focused on whatever on this other side, and the crypto camp's not focused. I mean, they're closer to it, to be honest, because they actually come from these traditional firms and they understand that space. But that's why I think we take a particular interest in this, is because money is really changing in real time. And there's a huge opportunity once you start to see what's working, what's not, and then you layer in the best asset we've ever seen.
100%. It's important to try to bridge the chasm between a lot of these camps. And while we talk about the crypto stuff, we talk about the fintech stuff, it's ultimately in an effort to tie it back to, what is the actual signal and what is important to understand from a fundamental perspective about this monetary reordering. And while a lot of the incumbents, fintechs, TradFi folks are still missing it and still building things without sound fundamentals, they eventually will see the light on a lot of these things. And so it's helpful and important to have the context around how these things are shifting and moving in real time. Liam, any other thoughts on either the JPM deal or the Klarna deal before we move on?
No, I think you guys summed it up well.
Well, let's do Klarna really quick, just because the Klarna I think is interesting, because this is going to change. Like the one thing that we know, and this is where like we don't have to talk deeply about it, but I think Kalshi lost like 50% of their trading volume because they were integrated in Robinhood, and Robinhood's like, screw it, I'm just going to make my own market. That we learn, whether it's business books or seeing here, it's all about distribution. And so Klarna does have an insane number. I think it's like hundreds of million, 114 million customers. And then they're sitting on, I think, 14 billion in cash deposits. And so again, I think this is a huge dynamic to pay attention to, is that if you're sitting in and around the customer or capital, you will be able to participate in creating your own stablecoin. You will be able to take that float and generate some kind of nominal revenue for your bottom line, or also pass back and have a competitive advantage to legacy firms. And then if you take it a step further, well, you just start to look more and more like an actual neobank, because I think that's what Klarna wants to do. Now, it'll be TBD if they can do it, but they do have the client base and they do have the merchant side that ties into cross-border. And then the other part that's really fascinating is basically partnering with Tempo, because this ties back to like everything's decentralization theater. We know that, but they're still going to play with the fact that it's crypto, it's digital assets, it's stable coins. It's a better rail than the existing Cobalt, whatever else exists, right? And so my understanding now is Tempo, because in Stripe, have all of these. It reminds me a lot like Microsoft. So Microsoft could just like launch a Slack competitor that was like, 50% of the actual product and like the client experience or consumer experience, but they can go and get like 100x the amount of distribution because of their scale. And it's very similar with Stripe, that they're now starting to win deals because they can layer in like persona and all these other interesting things. And then they're even offering like engineering resources to these groups, which I thought a lot about with like what we're doing at Onramp and Multi-Institution. When you start thinking about legacy firms, you can go offer integration services to help them get up to speed, because these companies don't have the like tribal knowledge and understanding of what's being built here. So I do think like this is just very interesting to pay attention to, because the more you can start to look at stablecoins and then how they'll sit next to Bitcoin, and people will slowly migrate over to them because their users will either take them as rewards, accept them as payments. And we didn't even touch on this, but like last week, Square and they're announcing stablecoins, I think launch in 2026. That is a huge like just thing that went under the radar, because I think that's something we've been talking about is Bitcoin and stablecoin sitting right next to each other. Really, I believe will be like the killer applications in the future. And we're just so early that those camps are on like polar opposites. But the closer you start to integrate them together, the client experience is going to be fundamentally better. And that's what Flash is also doing.
When it comes to holding Bitcoin securely, peace of mind starts with architecture. Onramp's multi-institution custody distributes control across 3 independent regulated key holders in a 2 of 3 quorum. No single point of failure, no pooled or omnibus exposure, segregated client-titled vaults. You retain full legal ownership while Onramp coordinates security, compliance, and operational workflows behind the scenes. It's strength of many delivered through the simplicity of one. Multi-institution custody is the foundation for everything we build. Sound infrastructure that distributes counterparty risk and provides fault-tolerant resilience with clear audits and institutional controls. And now Onramp is piloting flat, predictable pricing, making best-in-class Bitcoin custody and financial services more accessible now than ever. Onramp, strength in many, simplicity in one. To learn more, check out onrampbitcoin.com.
Yep. Very well said. I think there was, Michael, you might have brought this. There was just another stablecoin announcement. Stablecoin issuer Paxos acquires Fortify, bolstering its crypto custody and wallet offering. Was this related specifically to stablecoins or something else?
Different. So this kind of ties a little bit into, there was also a hack. The way I was going to tie it in, I'm sure you guys have other angles, but Paxos bought Fortify. Stripe bought Privy, which is a similar orchestration layer for like MPC, multi-party computation wallets. There was the Zero Hash, I think it's still pending acquisition, which is another orchestration layer and custody technology. And the point being is that we're seeing already at $85,000, $90,000 BTC that fintechs and TradFi are having to pay king's ransom for these assets because they can't hire the people. They don't have the technical or architectural chops to build this stuff out, but they're buying inferior technology. They're buying technology that nobody stores real wealth in, like Bitcoin. And so we look at the market and like what we're doing around multi-institution, and as the market proliferates, that large fintechs, large TradFi firms are going to start to look at real robust technology when they recognize they want to secure the underlying asset because X happens. If you can pull up X. It was the hack with, I forgot so Upbit. Upbit says an emergency $30 million hack uncovered internal wallet flaw that could let attackers derive private keys. My understanding, there was something with their cryptographic signatures that once assets were spent from various crypto wallets, you could back in with like, I think the AI tooling now to be able to reverse engineer the private key. I'm pretty sure it's probably built on multi-party computation. It's the only design surface to support, the number of crypto assets Upbit secures. And this just ties back to that main point, like that at the end of the day, as these assets monetize and they become hundreds of thousands of dollars and become cornerstones of businesses' balance sheets, users' balance sheets, and then personal balance sheets, this can't happen. This can't even potentially happen. And everyone's building their own proprietary kind of quote unquote janky implementations that are all proprietary, because that's the thing that doesn't get discussed is multi-party computation. It requires proprietary implementation. So Fireblocks' implementation is different than Copper's. And because they're not battle tested, and then they have to continue to update them because they have to support the long tail of crypto assets, they always find these vulnerabilities. And you can like Google MPC in 0 days. And so I just think this is such a huge like boon for like what we're doing, because people do not recognize that custody is broken. And as this continues to grow and the asset class grows, they're going to recognize you need robust custody solutions, and those robust custody solutions do not put anybody at a single point of failure of risk, which historically exists or has historically existed in this market.
Yeah, you said a lot of important things in there. Maybe it could be worth putting a finer point on, you mentioned MPC architecture that is supporting the long tail of crypto assets. It's typically proprietary. Maybe just for the audience, if you could characterize what that looks like versus Bitcoin native multi-sig and why it is just fundamentally different from a security perspective. And then on top of that, in terms of, at these different exchanges, like the bulk of assets is Bitcoin based anyway. And so, even if they are aiming to support all of these long tail crypto assets with something like MPC or their own implementation, the reality on the ground is like they still need to support the vast majority of their volume and holdings that is Bitcoin based. And so maybe just put a finer point on the audience of like MPC versus Bitcoin native multi-sig and what you mean by that when you say these things are not actually supporting like real long-term wealth.
Yeah, there's a lot. I'll try to make it tight and concise because it really has ramifications all the way to the existing market structure. So at the end of the day, cryptocurrencies by nature or leverage cryptography, and they leverage digital signatures. So you're producing a private key that maps generally to a public key. That's what, a single signature is historically how it's been done. Most people listening are familiar with like generating a private key on a hardware device or a phone. So multi-party computation is effectively taking that private key that's been generated by whatever algorithm or however it's set up, call it like Fireblocks, and it's one single private key, and then they're layering their own proprietary cryptography that's basically taking apart that private key and securing it in generally what's known as hot wallets. They're on phones, they're tied to some internet-connected device. And so whenever you go to make that digital signature, that private public key pair, you're coming together with multiple M of N shards for that single private key. And between that and the digital signature, you find all sorts of different implementation bugs, 0 days, social engineering, where assets are lost because you have one private key to that public key at the end of the day that have to match to move assets. Multi-sig does something completely different, which is an M of N of multiple private public key pairs. So the most common is a 2 of 3, where you have 3 private keys that are each individually in a like multi-institution format, or even in a like a Coinbase or BitGo Fidelity, is that private key doesn't exist by itself. It's usually sharded. And so you have multiple M of Ns all sharded, and each of those has to come together via offline coordination ceremony. And so the point in all of that is you need multiple private keys to be signed for each independent transaction. So it changes the whole logic layer of, even if like the address or the wallet withdrawal is manipulated, you need multiple keys that sign that offline before that asset is ever moved and before the digital signatures are ever produced. And the last part is that multi-sig is native to the Bitcoin protocol, which is the biggest point. Is multi-sig is a scripting language built into the asset, versus if you ever see these, and we did a great write-up, Brian did on the Bybit hack, that I think it was the largest hack, $1.2 billion, because they were leveraging quote unquote multi-sig, but it was a proprietary setup of multi-sig because Ethereum doesn't have it. And so where this turns into market structure importance is that traditionally the best institutions in the world, like the BitGos of the world, will segregate multi-party computation from multi-sig, and they'll use multi-party computation for digital assets, and then or multi-sig for Bitcoin because of its robust nature and its best-in-class understanding. It's battle tested. But there aren't many sophisticated people in this market. We talk to them all day long when people that are managing thousands of BTC and Bitcoin treasury companies have never set up a mobile wallet. They've never sent a Bitcoin transaction. That's just one example. Now you start to go to TradFi that stepped into this space. Think of it as like the Bitwises of the world. And those individuals step in and they believe that crypto and everything under the sun has value. And they throw the baby out with the bathwater and they just think about multi-party computation because they're trying to support the long tail of crypto assets. And so they put everything at risk, even though, as Brian called out, Bitcoin is from a total market cap, like anywhere between 55 to 60, 75% of the market. It takes most of the trading volume, most of the custody, but people don't recognize that. And again, this is just a product of how early we are, that when you educate somebody on this, like, oh, that's interesting. Didn't know that is actually how it works.
Yes. Thank you for walking through that. I think it's just important to expose some of those details around the differences in these architectures, because the biggest thing, in addition to the interoperable nature and open source nature and Bitcoin native nature of multi-sig, the biggest difference to me is like the actual attack surface of when you need to reconstitute an MPC wallet, you're bringing shards back together into a single point of failure. Whereas with multi-sig, the keys are actually distinct. And so it's a more resilient, fault tolerant, basically design surface, in addition to being native to the protocol. So glad we walked through that. We can move on from that stuff. I did want to
I would just say like one other thing on that too is like, this is why, regardless of which custodian or financial service you use, there is also an not just ideological reason behind being Bitcoin only, but also an operational reason, right? As you described, by supporting more and more of the left tail risk of crypto and being focused on other digital assets, that makes you necessarily upgrade or not upgrade, but change your MPC processes and protocol, which involves risk into how those keys are sharded and then come back together. So there is also significantly, outside of just operational reasons of Bitcoin being like the true battle tested and one digital asset with the greatest total addressable market, there are operational reasons for being Bitcoin only as well and using those services.
Yeah, and just to add to that, like, we can't expect users, consumers to go and validate individuals' cryptographic setups, how they manage, whether it's multi-sig or MPC. So when you look at a long enough time horizon, if this asset class is going to mature and be ubiquitous, it's very simple for people to understand, well, no single institution can move or lose my assets, full stop. Once you get any further than that, then you're like, well, I don't know where the risk lies. Because what Liam was saying is, even if you're on Upbit, I'm always shocked because every day, almost, it feels like every day, but it's definitely every week, there's vulnerabilities across digital assets and assets get lost. And I'm always like, well, how do they make people whole? Like, they can't be generating that much revenue. And so even if you're holding Bitcoin, if your counterparty is not securing it in the right way, or all the other assets, and they're playing in that game, if they have a hole, you potentially are susceptible to losses. And the last thing that ties in this, we don't have to go deep here, but it'd be worthy of a different discussion for a different pod, is, another validation on, like, we've been in this bear market is that there's no net new Bitcoin companies. Like, think about it. Like, there are, and on the margins, but like, when you think about the deal flow and the opportunities, they're few and far between for world-class like ideas built in like Bitcoin, and then monetization and commercialization today are very close to today. And I just believe that's a product of the best talent is still sitting at the companies, or maybe going into AI, maybe they're going a little bit into crypto. But the reality is we just haven't seen, like, think about, you would imagine there'd be a net new like Bitcoin, like stacking sats business, a new like exchange, right? It's the easiest today to build something like that. When you think about the existing incumbents that have B2B solutions, everyone I feel like has one today: Zero Hash, BitGo, Kraken. You can pick a segment of the market, different value added service, and nobody's launched anything, it feels like, in a while. And I think that's just a product of the market's just kind of gone out. We haven't had a lot of net new talent come in with interest. And I think as the price runs, we'll see more of that. But that's when we're also in a bull market.
Hey guys, hope you're enjoying the podcast. Wanted to give a quick word from early riders. We've had no shortage of exciting announcements the past few weeks. Last week, we announced an investment in Audio, a Latin American-based Onramp based in Mexico City and El Salvador. wonderful founders, multiple exits, had formerly exited Verifiable Bitcoin and launched Swapido, which rebranded to Audio last week. And then also Argo, a Sprott family company, incredibly excited about the intersection of gold and Bitcoin and what does that look like for managing and protecting wealth over the next coming, call it decade and beyond. We've included no shortage of research, investment memos around those company fundraising processes, just so folks understand how we think about companies, what we're looking at. If you're looking to build and are trying to get early riders involved, we'd encourage you to reach out. We'd love to speak with you, as well as if you're looking to get involved with early riders, we'd love to talk with you. We have no shortage of other opportunities we're actively looking at. A very exciting 2026 is upon us. And as we talked about during this episode, there's no shortage of M&A. A lot of these companies, the reality is they can't really build. They're going to have to eventually buy companies to really insert best practices, best teams, best infrastructure. So we're incredibly excited what we're building. We're looking for best-in-class talent and folks to get involved. And so if that's you, please reach out, michael@earlyriders.com, or you can reach out via the contact form. All right, guys, we'll talk to you later this week on the last trade, and I hope you enjoy the rest of the episode.
Yeah, I think a lot of that is also just price. But all good points. I did want to go to, I found this pretty interesting. This is a headline from last week that CoinShares is withdrawing certain US spot ETF filings, namely basically like single token ETFs for XRP, Solana, and Litecoin. And why I found this interesting is because I think it speaks to something that we've discussed on the show prior, in that, for the, if you're thinking sort of about the digital asset ETF complex, it becomes very difficult to differentiate yourself and compete. And so I think what CoinShares is recognizing here is that the BlackRocks of the world, the larger issuers, are probably going to dominate these sort of single token ETF products. And so what they are basically hinting at or suggesting that they are going to do instead is, basically more quote unquote sophisticated type strategies, probably more active, things that look like more active strategies, as opposed to just, single name ETFs. And so I think this is something that I've sort of expected for a while, because if you just think about, the Bitcoin ETF specifically, it's like, IBIT has amassed the largest amount of assets. And there's sort of this long tail of ETF issuers that have much smaller AUM. And so I think it's very difficult to compete, because on the fee side, it's sort of a race to zero. IBIT's going to be able to cut lower than you most likely. And so, well, what do you do? So there's a few different avenues here. I think, if I'm thinking about it, I think the way to differentiate would be on the custody side. That's where there's the biggest gap in terms of the inferiority of these products in terms of having single counterparties and having that custodial risk underlying. We haven't gotten to that stage yet, but what we are starting to see is different elements of quote unquote differentiation in terms of more sophisticated active strategies to generate additional returns on top of whatever the spot asset would do. What do you guys make of this? Do you think I'm onto something there, or is this notable?
I mean, I think the competition, to your point, is interesting. Like last week, I feel like either it was approved or close to the Dogecoin ETF. It's just like, come on, like how far are we going to go on the risk curve with those assets? And then to your point, like how much volume is it? And do you want to compete? I think like Hashdex as an example, they kind of stumbled into the ETF and they have like no trading volume. It's just there and they have to manage that from an annual like audit and everything. It's just a cost center. I do think there is interesting aspects to or interesting products. I think they're going to look closer to integrating like Bitcoin, to your point, of less on like just, I mean, people will do all of this, but I think the ones that will win will be the people that build structured products. And we're probably going to talk about the JPM style, where you can integrate like gold, BTC, and other like sound assets that can kind of maybe lower the volatility, but still provide some of the return profile. The point I'll make, though, ahead of custody, that I've been the most fascinated with, but it's probably harder than custody because it really takes a lens and conviction, is just one of these asset managers crippling down and only focusing on Bitcoin. Because if you think about it, they all support Bitcoin, but they treat it as this like passive thing. They focus on the other assets they can monetize to a greater extent because there's greater margins. And rather than say, okay, we're either going to do similar custody as everyone else with Coinbase or differentiated, but we're going to go harder in advisory, education, and really explain that Bitcoin is not a 2 to 3% position, but a X or Y position. I think fundamentally changes not only from the short order, from the long term when different advisors, because I think about Bitwise again, they're fun to pick on, is they played in this game and they were told, or they told the market, they're the crypto native firm, they're the most sophisticated. And they spent years getting distribution with advisors or working on distribution, and then Fidelity and BlackRock step in and they just like mop the floor because they have better distribution when it comes to FAs, asset managers across the board. And so, but the thing that BlackRock and Fidelity can't compete at as much as they try is around going 360 on Bitcoin, the asset, how to think about it, how to legacy plan for it, the things we do here at Onramp. And so I think that's a fascinating angle that none of these people take because A, they can't raise money on it. B, like their shareholders and the people they hired would just, leave. And then C, but that's the thing that I think a lot of these firms are hungry for because nobody wants to be told that every crypto asset on the universe is valuable and you just need a like basket of them and then to rebalance. It makes 0 sense.
Well, the problem with that is that over a few years time horizon, you lose credibility taking that stance, right? And so I think that's the big thing that a lot of these firms are missing is that, in order to build trust in financial services and think long term, like you should be focused on the asset that can actually allow you to do that. And so these other crypto tokens, these sort of flash in the pan things that come along every cycle, by focusing on them and putting them in the same breath as Bitcoin, you actually are hurting your own credibility over longer time periods. And so I think this will happen slowly, but it won't happen right now because right now the flavor of the day is stablecoins and tokenization and doing all these other things. And so to your point, Michael, it'd be very difficult to raise on saying, hey, no, we're just pivoting to Bitcoin only. And we're going to maybe make some structured products like JPM announced last week as well. Sorry, I cut you off, Liam.
No, I was just going to say that's sorely needed in the market, but it can't be our only product because everybody knows that the ETFs are kind of an inferior product. And so it would need to kind of be somebody who's in the Bitcoin space and doing a full stack product where they can offer Bitcoin ETFs and be Bitcoin only, but also offer like best in class custody and structured products outside of just ETFs in particular. And then on a slightly different note, like we haven't touched on the IBIT or the NASDAQ filing on IBIT's behalf to raise the limit of contracts by 4x too by the end of the year. And just because I think that is naturally just where they've seen most of the product market fit thus far for IBIT. It's primarily just people who have IBIT in their retirement accounts, as well as just high frequency hedge funds that want to make money on like the arbitrage or use options on it. And so if you don't have the options volume and you're not IBIT, it's going to be extremely difficult to make money if you don't have a view on Bitcoin itself, just as the asset.
Yep. It's a good point. Glad you raised that. All right, guys, I know we are coming up on time. Anything else you guys wanted to cover? There was an OpenAI data breach we didn't touch on, but I think that's to be expected. We've talked about it in the past. Data will be leaked into the future, and that spans across your AI provider as well as your crypto exchange or potentially your hardware device manufacturer. Data will be leaked into the future on an increasing scale. Anything else you guys want to cover though?
Should we maybe pick one last segment? Do we want to touch on like China and just kind of some of the stuff happening around? I think we're going to see. Well, lesser on the robots. I was thinking about like their antagonistic nature, and this is interesting, but antagonistic nature towards stablecoin specifically. Yeah. But the other angle could be on the IBIT structured product, because I think that's also interesting. With I don't think we've talked about it yet.
Yeah, you mean the structured Bitcoin note that JPM announced?
Yep.
It kind of aligns with what I was saying before around like, well, how do you differentiate? And I think it is a positive signal that they're at least focusing this product, this launch around Bitcoin specifically. And I think it also tells you something that, BlackRock's IBIT ETF is their, top revenue generating source in the entire business. And so I think JPMorgan is looking at that and say, well, we should probably focus something on Bitcoin. And what hasn't really been done is these sort of structured notes where you're limiting some of the upside, but you're giving basically a floor to the investor in terms of the potential downside. So, Liv, do you have any thoughts on this one in terms of, I think we're going to see a lot more of this type of stuff. And it's honestly surprised me that it's taken this long to see some of this. But when people think about Bitcoin, typically they are, perceive it as highly volatile. And there's a large cohort of investors out there who probably would like some form of exposure to it, but without, the potential downside. So any thoughts on this one, guys?
Yeah, it's interesting that they've done this for a 4-year note, so it's aligned somewhat with the Bitcoin cycles, if those are still a thing. We're just so early into this market that people don't even know what they necessarily want, because sophisticated investors can pretty much go out and create these types of products and services themselves, but they need somebody in order to package it and give them a product that they maybe don't know that they want, or don't know how to make money on if they are going to go out and do it themselves. And so this is going to be extremely profitable, just because they can go out and offer a package solution to those types of folks who want real Bitcoin exposure, and think about it over a relatively long period of time, and know that they need to have some sort of view on it just as a macro asset. They don't need to even necessarily have a strong conviction on where Bitcoin itself is going, or that as an asset class of itself. They just necessarily know that how this is performed in the past, and have some sort of view on it in the future. So we're going to see no shortage of structured products, like you've seen with the IBIT and this. A lot of the volatility, hedge funds are going to try to make money on, and so maybe that's why things have been a little bit slow this year. I'm not going to say that Bitcoin's never going to be volatile again, but it probably will have some more volatility continue to be stripped out of it. And then lastly, it's just going to increase the distribution of Bitcoin over the near term, as people realize that they can make money on this somehow, and then understand that this is actually a great way, either in your personal account or for your clients, to make money over the long term too, to have just a view on the underlying asset itself.
Yeah. I think this is most fascinating to me, because to your point, we're going to see a lot more across different customer segments. We've talked a lot about permanent capital. And if you have this understanding, because it is asymmetric, that Bitcoin goes up and to the right over time because it's just a proxy for dollar liquidity, that you can build products that meet the market where they need to be, and I think there's a lot of discussions that happen today. They're just too early, and they're not scaled appropriately. So when you think about bit bonds, credit, real estate, the individuals that have talked about these products are at too large of a scale. And there's a lot that's baked into why you can't start at hundreds of millions, if not billions of dollars, but you can start at smaller financing. And another example of something like this is in Latin America. We've talked with firms building products that traditionally in Argentina, Brazil, it's 25% on average to take a business loan. But we know that the Bitcoin market's closer to 10 to 12%. What happens when you can start to create structured ability for individuals to take loans in Latin America baked on whether it's balance sheet Bitcoin, the business holding Bitcoin, or dual participation and buying that Bitcoin, lending against it, and then owing some interest, and then offering the capital providers. We've seen this in the real estate market with what's going on with being able to take conservative leverage against your real estate equity and buy some BTC. But again, it's still so early that it's really the other side of the market, which is the individuals providing the dollars, where they have to get educated. You have to start on smaller scales before you can go into large capital markets, similar to what MicroStrategy did before it got to fixed income. And so I think this is really a fascinating area where we'll start to ideally see more crypto folks. Two Prime's a great example where they pivoted directly to Bitcoin only. They do interesting things around structured products on Bitcoin-backed loans. Ledin went that direction. And so we'll see this migration from crypto into more sophisticated Bitcoin products to meet the rest of the market where they're at. And the beauty of that is then once somebody gets their slight exposure into BTC, because they were just trying to hedge risk or get some nominal return, they can start to learn more about what the hell they're holding, especially if this asset appreciates and they're like, well, what the hell was that? Why did it just do that? And then they start to go down their own version of the rabbit hole.
Yeah, and it's also worth noting too that Jamie Dimon isn't going to create this in a vacuum. He's definitely having clients that are knocking down his doors that are asking for either this or something like this, and it's likely had some sort of test group before they're announcing it more broadly too. So this is definitely something that, like all of the best financial services, are going to be demanded at the margins by clients that want these products. And if the JPMorgans of the world don't offer them, they're going to go somewhere else.
Yeah, and the only other thing I would say is like you don't create a structured product like this where the upside is capped and you would benefit as the issuer if you don't believe in the asset medium to long term. And so I think that's the biggest signal of this to me is like not only have they seen the writing on the wall with what IBIT and BlackRock have done, but they at least internally have people who are bullish Bitcoin medium to long term, or they wouldn't be creating this product. All right, gents. I think that's a good place to wrap. A little bullish ending.
Good stuff, guys.
All right. See you
Thanks,
next week,
everyone.
gents. Later.
Here's what keeps Bitcoiners awake. You're still securing millions of dollars the same way you secured thousands. That hardware wallet in your drawer, your family's entire future depends on you not losing it, forgetting the PIN, or something happening to you. Onramp's multi-institution custody removes that burden. 3 independent institutions hold your keys, no single point of failure, no seed phrases to protect, no explaining complex recovery processes to your spouse. And now we're offering flat tier pricing. One predictable monthly fee starting at $250, whether Bitcoin is at 100K or 500K. Plus, with Onramp IRAs, you get the same institutional security with tax advantage growth. This is how smart investors protect generational wealth without the weight on their shoulders. There's strength in many. Learn more at onrampbitcoin.com.
Thanks for listening to this week's episode of the show. If you found the information valuable, please share the episode with a friend or leave a rating on your favorite podcast app. All the links we discussed in today's show will be in the show notes inside your podcast app. Before we finish, a quick reminder that Onramp Media is for informational and entertainment purposes only, and nothing should be construed as investment or legal advice. Regardless of where you are on your Bitcoin journey, we'd love to hear from you. Visit onrampbitcoin.com/contact to schedule a consultation with one of our private client advisors.